In this video lecture, we're going to go over some of the basics of economic policy at the federal level. And when we're talking about economics at the federal level, the goal for every politician is to achieve economic growth. As we talked about much earlier in the year, voters tend to vote with their pocketbooks, the so-called pocketbook vote, where voters are going to reward at the party in power during good economic times and punish the party in power during periods of economic downturn. And generally speaking, there are two main routes that the government can try to go to promote economic growth. The first is going to be to lower taxes. The second is going to be to create government programs that give people jobs or help strengthen the economy through building infrastructure or things of that nature. And those are the two main routes that politicians are typically going to look as levers and mechanisms for promoting economic growth. The unfortunate reality for politicians is that what makes good economic sense often makes poor political sense. As the first political cartoon on the screen kind of alludes to, voters have a love-hate relationship with government spending. They tend to want to cut and reduce government spending, but at the same time, they don't want government spending to be cut that is, quote unquote, their government spending. They don't like government spending in the abstract, but they love it in the concrete, in the form of specific programs that benefit them or their area. As a result, what that leads to is some political decisions that don't necessarily lead to good economic sense. And during this unit, we'll study the impacts of deficit and debt. The political cartoon at the bottom of the screen or on the left kind of indicates the conflict that is created by these twin pressures of wanting to lower government taxes but maintain popular spending programs. Obviously, that's not a sustainable proposition in an economic sense. And so you get the cartoon showing the government simply cutting a hole in the ceiling to run up even larger deficits so that they can, so that elected officials can react to public pressure desiring lower taxes and more government programming. Now, what the government's attempting to do is to grow the economy. And that's a really hard thing to define. There are numerous metrics that economists look at to determine whether or not an economy is quote unquote growing. It's not as simple as just looking at whether or not your paycheck goes up in a given week. This isn't an economics course, so mercifully for you, you're not going to have to know every leading indicator of economic growth. But the one that you do need to have an awareness of is gross domestic product, or GDP, which is consistently relied on as one of the top measures of economic growth. GDP, the definition is simple. The reality of calculating it is hard. The definition is on the screen, is simply the total value of all goods and services produced in an economy in a given year. So it is literally the value of every single thing and every service provided in the United States in a given year. Sounds simple on paper until you remember this is a nation of 330 million people in the world's largest economy and seemingly infinite numbers of economic transactions occurring. The way economists try to compute GDP is using a formula that combines four factors. The first, C, the consumer factor, is the total amount of consumer spending. So what you and I do if we go to a restaurant or go to a store or shop online, that would be considered consumer spending. In the United States, that's about 70% of our economy is driven by consumer spending by American citizens. The second factor or area that economists look at is investment spending. And this is spending that businesses basically reinvest in itself. It would be a business building a new factory. It would be a business buying new computers or new equipment. So reinvestment into the business in order to improve production. The third area of spending is government spending. In the United States, this is a significant chunk of spending because of the trillions of dollars a year that our government spends on programs. And finally, the fourth factor that goes into GDP is the net exports from a country. So this is the total value of goods and services sold to other countries minus the total value of goods and services purchased from other countries. And for about the last 30 years, the United States has ran a trade deficit, meaning we bring more stuff into the country than we sell out of the country. which is something that politicians, especially Republican politicians, frequently seek to remedy. The U.S. economy, by the measure of gross domestic product, is the largest in the world and has been really almost unchallenged since World War II or even a little bit before. But gross domestic product is that measure that typically politicians are going to rely on first and foremost to determine if the economy is growing. They want to see the total value of goods and services sold in the country produced in the country, increase on an annual basis. What politicians want to avoid at all costs are what I'll consider the economic bad words or curse words. We all know that as young children, there are certain words that if you say them, they are terrifying because you know that there's going to be a consequence. In politics, there are two words that an elected official wants to avoid at all costs because they know there are going to be consequences from voters if these words show up. The first is recession, which is a word that generally gets thrown out as a generic way of saying bad economic time, but it actually has a more specific definition. A recession is a period of 6 straight months, 2 quarters, so 6 straight months of declining GDP. So the economy is literally shrinking for 6 straight months, and the total monthly output of the economy shrinks over that half-year period of time. This is a word that politicians never want. If you're the incumbent, you don't want to be serving during a recession, because what happens is if the total goods and services produced decline, then that means businesses are making less money, which means they have to cut costs, which means they're going to lay people off. And recessions and unemployment generally go hand in hand. As you can see in the chart on the screen, recessions are a natural part of economic cycles. There's no country in the history of the world that has experienced unchecked, continuous growth over their entire life cycle. Every economy experiences growth and contraction. The goal for a politician is to make the periods of recovery really long and the periods of recession as short and painless as possible with the fewest number of people losing their job. The second economic bad word that politicians never want to hear is inflation. And typically, inflation and recession don't coexist. The only time really in US history where it's clearly coexisted was in the late 1970s when Jimmy Carter was president. That was known as stagflation. And Jimmy Carter got trounced in re-election by Ronald Reagan. So that was terrible for the incumbent elected official. But typically, recession and inflation occur at different times. Inflation tends to occur during a period of economic growth. And what inflation is defined, as you can see on the screen, is a period with a general increase in the cost of goods and services over time. So what's happening is the price of everything across the board, not just one item, not just gasoline or not just milk, but the price of everything starts gradually creeping up. And what makes inflation dangerous, both economically and for politicians, is that if all prices across the board rise, then the purchasing value of a dollar decreases. So for example, if I am on a fixed income of $20,000 a year, and every year the cost of basic household necessities goes up by 5%, then it's not going to be long before my fixed income can no longer cover the things that I need to, because they simply cost more and I'm not making more money. Inflation is the answer anytime you hear a parent or aunt or uncle or grandparent or just generally old person like me talking about when I was young, Coca-Cola only cost 10 cents, or I could go to a movie for a quarter. The reason why is because prices have generally increased over time. And so politicians want to combat heavy inflation. Small inflation, 2% inflation, is typical in an economy that's growing because businesses will seek to raise prices a little bit to make more money. And businesses will need to raise prices to offset some costs associated with growth. But rapid inflation can cause severe problems for individuals because their dollars, their salary simply won't buy as much, so politicians seek to avoid it. In terms of how our government tries to combat the bad words, recession and inflation, there are 2 different types of tools. Number 1 is what is known as fiscal policy. Fiscal policy refers to the government's attempt to regulate the economy through taxing and spending. A super important definition. I'm actually going to repeat it on a video that you could rewind. That's how important it is. Fiscal policy is the government's attempt to regulate the economy through taxing and spending. And who controls fiscal policy in the United States? Well, at the federal level, it's Congress and the president because they control the budget cycle. And the chart on the screen shows you the basic textbook for how fiscal policy should react to the two bad words of economics. During a recession, the government should increase spending and lower taxes. Why? Because lowering taxes gives people more money to spend, and consumer spending drives GDP, and raising government spending increases government spending that factors into GDP. During inflation, when prices are rising, the government seeks to cool off the economy by lowering its spending and or raising its taxes, both of which will pull money out of the economy. And if you pull money out of the economy, sometimes students struggle with, like, why would you ever want to pull money out of the economy? Well, if you're dealing with inflation and prices are rising, that means your dollars are becoming less valuable. But if you constrict the total amount of dollars available, each dollar becomes more valuable. So think of it this way. If in class, I gave every student a get out of taking a test free pass, those passes are valuable, but they're not uniquely valuable because everybody has one. But if I only give one student a get out of taking a test free pass, well, I bet you can figure out how valuable that pass is going to become and how much that person is going to be able to sell it for. The same applies to dollars and to money. The less there is, the more valuable it becomes. And so during inflation, government tries to use lower government spending and higher government taxes to cool the economy off. Now, that sounds fine in theory, but remember, politics isn't economic theory. Politics is driven also by factors that consider re-election. And there have been two dominant theories of fiscal policy that have dominated, dominant policies that have dominated in America really since the time of Franklin Roosevelt forward in modern US government. The first theory is Keynesianism, based on the economic theories of the British economist John Maynard Keynes. He's the very dapper looking guy in the black and white picture. Keynes's belief was that during a period of recession, the role of government was to spend out of the recession, that government spending should be increased at all costs in order to jumpstart the economy, to basically shock it back to life by pouring money in. As a result, Keynes wasn't concerned about deficit spending or an accruing debt. He believed that it was a short-term evil that was necessary to combat a recession and then could be addressed when the recession was over. The most important example of Keynesian economics in U.S. history is Franklin Roosevelt's New Deal. Roosevelt's New Deal was basically textbook Keynesianism, that Roosevelt jump-started the economy by spending on program after program after program, and then hyper jump-started the economy with spending on the build-up to World War II. A similar approach on a smaller scale was taken in 2009 under President Obama to combat the 2008 recession. In that year, Congress passed a $700 billion stimulus package, meaning additional spending beyond the annual budget, again, as a way to spark and jumpstart the economy. One of the challenges of Keynesian economics, obviously, is Keynes was only worried about getting out of the recession. He was an economist. He wasn't a politician. And so what politicians like a Roosevelt or a President Obama will struggle with is once the recession is passed, people don't want the programs to be cut. An economist would cut the program to balance out the budget, but that doesn't necessarily make good political sense, and it angers voters. So a Keynesian approach over time can lead to sustained higher spending. The second dominant fiscal theory is supply-side economics, which in American political theory is most frequently associated with the color picture on the screen, which is Ronald Reagan. Reagan was president during the 1980s, and supply-side economics in American politics will often be referred to as Reaganomics because it was the core economic belief of Reagan. Instead of spending out of a recession or having government spend to jumpstart the economy and foster growth, supply side economists believe that the role of government is to focus on cutting taxes to foster growth by putting more money into the hands of people who in turn will then spend the money. At its most extreme or farthest to conservative ideology, you often will hear of trickle down economics, which is the belief that taxes should be cut, especially for the wealthiest, because the wealthiest will then use their tax cuts to reinvest in their business, which will create jobs for others, which will then, as the name suggests, trickle down the economy. Supply side economics was, as I already indicated, the preferred approach of Reagan during the 80s as he cut income taxes and believed that the cuts would facilitate economic growth as people spent more. George W. Bush took a similar approach to his tax cuts in the early 2000s. The Trump tax cut of 2017 can be considered another example of supply side economics, that lower taxes will lead to economic growth. Beyond fiscal policy, there's one other policy that government can pursue to try to regulate the economy and combat recession and inflation. And I should have noted, with fiscal policy, Congress's taxing and spending, it's a crude tool. Congress cutting taxes or spending more money isn't like flipping a switch that automatically jolts electricity into the economy. There's typically a delay. Even the most successful economic policies are going to take several months to kind of work its way through the system of the economy. So fiscal policy is a crude tool, but it's what Congress has available. The other policy area is monetary policy. And monetary policy is simply controlling the amount of money in circulation in the economy. If the economy is struggling, put more money out there so people have money to spend. If the economy is heating up too fast, if you're dealing with inflation, pull money out so that, again, using my test pass example, the value of a dollar will go up because there are fewer of them. In American economics, monetary policy is not controlled by Congress. It's controlled by the Federal Reserve Board, often called the Fed. The Federal Reserve Board is the nation's series of central banks, kind of like the Bank of the United States that we talked about in McCulloch versus Maryland, but not exactly. It's a little different. But the Fed is the nation's central banking system. And Congress has delegated to the Fed the authority to regulate the money supply. So Congress has given that authority to the Fed. It's a classic example of delegation of legislative authority. The Fed is comprised at its leadership level of a board of 7 governors. So the Fed is one of the regulatory commissions that we talked about in the last unit. Those 7 governors serve staggered 14-year terms, meaning that every 2 years a governorship becomes open. And those governors are appointed by the president, confirmed by the Senate. Since they are presidential appointee, or since they are a regulatory commission, remember, they are beyond the reach of the president once they're confirmed by the Senate. They cannot be fired for political reasons. Once confirmed, they're serving 14 years, unless they retire. And as I said, the Fed's job is to control the amount of money in circulation in the United States. The Fed does so using 3 main tools. Now, the chart is going to show you the main tools of the Federal Reserve Board. And in an economics class, this would be a whole unit just to dig into how the Federal Reserve attempts to control and regulate the U.S. money supply. For AP Gov exam purposes, the most important part of that chart is the bottom row. The Federal Reserve Board controls the interest rates that are charged on loans in the United States. And I should say the Federal Reserve Board indirectly controls interest rates in the United States. And the way it does so is the Federal Reserve, at its core, is the bank for banks. You can't open an account in the Federal Reserve Bank, but banks have accounts with the Federal Reserve. Bank of America, Wachovia, pick all your big financial institutions are going to have accounts with the Federal Reserve. And sometimes banks have to borrow money because they find themselves short of cash because they've given out all their deposits, or they want to grow. And so they need additional money, additional assets. Where a bank goes to borrow money is to the Federal Reserve. But the Federal Reserve is going to charge the bank interest when it borrows, just like a bank charges you interest when you borrow with a credit card. There's an interest, there's a rate you have to pay for the opportunity to borrow money. The feds control the rate that banks pay. Well, banks are seeking to make money, so the rate banks have to pay the Fed will impact the rate that individuals have to pay banks to borrow money to purchase homes, purchase cars, invest in businesses. So in a indirect kind of trickle down fashion, the Federal Reserve influences and controls the interest rates charged on borrowing in the United States. And this is the Fed's primary tool for attempting to regulate monetary policy. During a recession, as the chart shows, during an economic downturn when the economy is shrinking, the Federal Reserve will typically lower interest rates. This is what the Fed did in 2008 during the recession. They basically cut their interest rate to almost zero and told banks that they could borrow money free of interest. Now, that meant the banks still had to pay the Fed back, but there was no interest charged, which in turn allowed banks to lower interest rates on individuals. Part of why I purchased my first home around that time, not first home, part of why I moved to Blythewood at that time from our first home is because interest rates were so low that it was attractive to buy housing. And that's what the Fed wanted during the recession. By making it cheap, quote unquote, to borrow money, more people will take out mortgages and purchase cars, and businesses will invest because they don't have to pay as much to borrow. And that should, in theory, stimulate the economy by pumping more money into the economy through borrowing. The flip side, during a period of inflation, the Fed will raise its interest rates to make borrowing more expensive. And if people don't borrow, money's being pulled out of the economy. Now, when I say money, the Fed's not controlling the actual printing of cash, like physical dollar bills. The Treasury Department does that. The Bureau of Engraving and Printing and the US Mint control that. The Federal Reserve Board is controlling the more abstract, large money supply of the trillions of dollars that exist in the books of banks and businesses. Like Bank of America may have assets of, I don't know, $10 trillion, but they don't have $10 trillion in a vault somewhere waiting on a supervillain to steal it. They have $10,000 in their computer system. And the Fed, by controlling interest rates, can spur borrowing or discourage borrowing, which will cause changes in those computer balance sheets. So during a recession, the Fed will lower interest rates to spur borrowing and monetary growth. During inflation, the Fed will raise interest rates to discourage borrowing, which will contract and decrease the amount of money in circulation.